When someone wants to leave a tax-held country, this should be the key question, and they ask themselves, because it's useless to have your company there, your tax residency there, if your country of origin is going to come after you, and under internal law or treaty ends up tearing you apart. I understand that every country has its own regulations. I understand that each country may interpret things differently. But here I want to explain you how most countries tend to track down tax residency to a greater or lesser extent. I get it, if you are living in India, they probably won't come after you even if you don't do everything perfectly. But if you are living a more aggressive country like European countries, like Spain, as was my case, or France, or the UK, or any other similar country, be extremely careful. This is not advice for anyone in particular, but if you do need help, I invite you to fill out the form in the description, and we will assess your situation properly and find the right solution for you. Can you ever be 100% sure that they will not come behind you? No, because they can always open a case if they feel like it. And let's be honest, if you have money, they will go after you if they think they have got a solid shot. Or not, many times they lose cases. But what you can do be sure of is that you are doing things by the book. As we know, most countries determine tax residency based on one of three criteria. First one, staying 183 days or more in the country during the fiscal year or 2-year linkage, meaning a combination of presence over 2 years, center of economic interests, and center of vital interests. Simple to state, but complex to apply. From my perspective, there are 3 levels of protection someone can use. First one, protection through worldwide taxation versus territorial taxation. Many people recommend choosing a country that uses worldwide taxation instead of territorial taxation. Why? For several reasons. Reason 1, except for Panama, most countries with territorial system don't have any form, checkbox or section in their tax returns where you can declare that income you earned abroad and paid 0% on. So you won't be feeling anything similar to a return in your previous country. Is this a problem? Depends. Reason 2, because over the year, territorial systems are being phased out or excluded from tax treaties, just like other special regimes that are also being eliminated. Let's look at Spain's tax treaty with Paraguay. Article 4.1, definition of resident, contains the standard clause you will find in most treaties. The term resident of a contracting state means any person who, under laws of the state, is liable to tax therein by reason of their domicile, residency, place of management, or any other criteria of a similar nature. However, this does not include persons who are liable to tax in that state only in respect of income from source located in that state. So unless there is previous case law or precedent, and given the wording of treaty, you might be excluded if your only tie is to a territorial country. Therefore, if you want to rely on protection number 3, the double tax treaty, this could be a weak spot. Now let's look at the OECD model treaty commentary. The purpose of the second sentence is to exclude from the definition those persons who are not subject to comprehensive taxation in a state. Otherwise, its application could exclude all residents of countries applying a territorial tax system, which is clearly not the intended outcome. Every case is different, but from my reading, I would recommend having a year-long rental contract, an utility bill in your name, and certificate of tax residency, field tax return, invoices issued, and even paying some tax, so you are not at zero. The reason number 3 is having worldwide taxation can often help you build up proof of income or company valuation, and this supports both internal regulation and treaty-based protection. The 4th reason, when you need to apply for a visa, take out a loan or prove your income, if you haven't filed proper tax returns, it's harder to provide proof of your financial standing. There are other smaller reasons, but those are the main ones. The second protection is through internal law. As we have said, Spain, like many other countries in Europe, Asia or Latin America, for example, considers you a tax resident if you spend 183 days or more in the country during a tax year, or you are linked across 2 consecutive years, or you have your center of economic or vital interests in the country. If you are not faking your tax residency, I assume you are not overstaying, so that already gives you a layer of protection. Now let's talk about economic center of interest. There is a lot to consider here. Some key factors that tie you economically could be assets located in the country, properties, premise, shares in a company, shares in a foreign companies held by your previous country brokers, management roles in companies in the country, bank accounts and financial transactions with any bank account of the country, income from business activities, rentals or any other economic activity carried out, investment funds, pension plans or life insurance contracted. Of course we could mention more, but those are the main ones. Keep in mind, it's not the same to be tied to a country through wealth as it is through income. If you own a fully paid apartment worth 200,000 euros and it's not rented, they can only go after for you for wealth, not income. And if your foreign wealth is greater, your previous country has no claim. Important, having greater wealth abroad doesn't mean you have spread out 80% of your wealth globally. It means that in a single foreign country, like your new country of residency, your assets exceed those in your previous country. If you own an apartment worth 200,000 euros in Spain and a bank account with 300,000 euros in the Emirates, then you have greater wealth abroad if that's all you own. But in practice, you usually have more things, even if small, so you have to do the math carefully. Now, if 40% of your wealth is in Spain, 30% in the Emirates and 30% in Paraguay, Spain becomes your main economic center. That's a risk. In a dispute, if Spain claims tax residency due to income and your residency is in Paraguay, not in the Emirates, then it doesn't help if you have assets in the Emirates. The treaty dispute would be between Spain and Paraguay, so the smart move is to move your wealth to your tax country of residency. Why? To make Spain's internal rules harder to enforce and to gain leverage under the double taxation treaty, which is the protection number 3. If you don't have more assets in Paraguay than in Spain, the Spanish tax office has the upper hand. Let's assume they are going after you because you have earned more income in Spain than in Paraguay. Your economic interest center is in Spain, so you are already on the defensive. Of course, I have mentioned Paraguay because it's the tax residency that all people is making right now, and Spain because it's a tax-aggressive country that many people don't know. Now let's talk about vital interest center. Usually this means spouse and children. Property separation doesn't help, you must be legally separated or divorced to avoid the tie. And with children, unless you don't have the custody, you are automatically tied to Spain. Even shared custody links you to the country. As I always say, we can predict for sure whether the tax office will pursue you, but we know how they tend to do it, so prepare in advance. Now let's talk about protection through double taxation treaties. Pay close attention, this is where the surprise comes in. Double taxation treaties are designed to prevent people from being taxed twice on the same income, or to allow favorable tax transfers between countries, for example, lower withholding. Usually you have this double tax treaty between your country of origin and the new country, and there we have tiebreaker rules that follow a strict hierarchical order, and depending on your specific case, they determine where your tax residency is considered to be in a country or another. These rules are usually as follows. First, permanent home available. Second, center of economic and vital interests. Third, habitual abode. And this isn't about the number of days. It also considers the logical pattern of where you have always returned after traveling. This part is not simple and many people get it wrong and lose their case because of it. And fourth, nationality, the country of which you are a national. And you just pay taxes in the new country, although you have center of economic interest in your previous country. But this only applies if there is a favorable tax treaty between the countries and it follows the OECD model, which is often not the case. That's why the most important thing is to make sure under your home country's internal legislation they cannot consider you as a tax resident. That said, many of these treaties are intentionally written so that regular individuals can't benefit from them when changing tax residency. In other words, they are worthless. You can check, for example, the tax treaty between the UAE and Spain, or the UAE and Germany and the UAE or Brazil, for example, and this tax treaty requires you to have Emirati nationality, which you don't. So for you, this tax treaty probably is worthless. Also, there are many more clauses that could exclude you. All depends in double tax treaty that your country has with the now country. This is why nomads often have the advantage. They leave no trace in their country, making it very hard to classify them as tax residents, while older businessmen maybe has some houses, local business, or other things that are attached to the previous country. Let's say someone is separate or divorced, but owns a house jointly with their ex. That house counts as residence unless it's rented to a third party with no relation. I think this video covers the most common issues and how to protect yourself using 3 types of protection. Whether you need 1, 2, or all 3 depends on your specific case. We know that all tax agencies have limits, but it's always better to be protected before taking action. Andorra isn't perfect, Paraguay isn't perfect, the UAE isn't perfect. It all depends on your situation and how hard the tax agency could hit you. If you want us to review your case in detail, avoid mistakes, and build a path toward 0% tax or the lowest legally possible, fill out the form in the description. We help families do this every month.